Remitly is one of the fastest growing companies in the payment space, but the big opportunity lies in the fact that it's not priced for that growth at all. It's kind of like an early Uber. The business has tremendous potential, but current expenses to increase scale and reach still cover up the underlying earnings power.
We are just now hitting the inflection point though. Remitly is already free cash flow positive, and if we look at it at a steady state valuation, the business is profitable across the board.
And those inflection points tend to be when the market wakes up to the potential of a company, and therefore also its stock, and the returns are huge.
Today, we are talking about a company that most of you have probably never used and perhaps have never even heard of. But millions of people around the world do rely on it every single month. Today's pitch is on Remitly. Remitly operates in the, remittance space, hence the name. It is a fast-growing company, and from what you've already told me, Daniel, it is at an inflection point where in the next few quarters, the true earnings power of that business will show through. And the other big change is not so much on a company level, but on an industry level. For decades, legacy players like Western Union have dominated the field, but we are clearly starting to see that this dominance is vanishing at a record speed, which leaves a lot of room for digital-first companies like Remitly to gain market share. Before we get into all that, how about you give us an overview of Remitly and maybe the remittance space overall? And I should say, Daniel, we spent about an hour beforehand talking about payments, so we should be pretty primed for this conversation.
We had a long introduction, that's safe to say, and you already did a great job of outlining why Remitly might be such an interesting pick right now. It's a much smaller company than the ones we usually look at a market cap of around $3.5 billion, and it's a lot younger as well. Remitly was founded in 2011 by Matt Oppenheimer, who was working for Barclays Bank in Kenya at the time. And for us living in the US or the EU, it's probably hard to imagine how much of a headache payments can be in other parts of the world. But Matt saw that firsthand, and he saw how expensive, frustrating it was for people to receive money from abroad just because of long lines, high fees, and also unpredictable wait times. And a lot of that was because back then, most remittances still relied on cash agents, and there were few digital alternatives, especially in emerging markets. And that's how he got the idea for Remitly. And why not use technology to make international money transfer faster, more affordable, and also more transparent? And the vast majority of innovations in the payment space in the last decades have been about just these three things. So Oppenheimer teamed up with his two co-founders, Josh Hawk and Shiva Gulati, to launch Remitly. And from the beginning, Remitly was designed to be digital first. So no agent networks, no physical branches. The decision helped to keep costs low and user experience also tightly controlled. And over the years, the company expanded corridor by corridor. And by the way, the term corridor just describes the payment connection between two countries. So the US-Philippines corridor describes the transfer of money between, the US and the Philippines. Remitly prioritized routes where the traditional players like Western Union and MoneyGram, two of the players we talked about in our introduction, were charging the highest fees or had poor service. And by 2017, they had reached 1 million customers. In 2021, Remitly then went public on the NASDAQ, raising around $300 million. And by now they serve over 170 countries and process over $50 billion in send volume annually. And one of the reasons for Remitly's success has been their focus on remittances only and only for migrants. They've resisted the temptation to, expand into unrelated financial services or business remittances, at least for now. And we've seen with PayPal how that sometimes can change when the company grows.
As you know, Daniel, as something of a running joke on this show, that I am not a huge fan of the payment sector or financials in general, but we talked a little bit earlier about how my concern is that payments long-term is sort of a race to the bottom. And Nubank was an exception for us, but I do remember, this is kind of a flashback for me, when I first went to study Bitcoin a number of years ago. Of all things, I remember learning about how these high remittance fees from companies like Western Union were not very fair, let's say, to the workers who were trying to send money back to their family. So why don't you give us maybe a bit more of an overview of the remittance space in general, And like I said, every time I feel like I start to understand payments, it just seems like there's always another wrinkle that throws me for a loop. So why don't we just keep this at a very beginner level and as simple as possible?
It's interesting because we talk so much just because we do these episodes and we discuss investments, but I didn't know how deep you kind of were into payments just because of, your background in Bitcoin, if I might say so. And I kind of feel bad to put you through the third payment company by now. First it was Visa, then just 2 weeks ago PayPal, and now Remitly. But I do feel this space is very interesting because the market soured a bit on it since 2021. And I personally don't feel like it is a race to the bottom. We will talk about that later on today and perhaps also in one of the upcoming calls in our community that are about the payment industry. So you got to go through it once again. But I just feel that highly profitable businesses like PayPal are disliked by the market, and even the fast growing ones like Remitly are not getting the credit that I think they might deserve. And I think this rather bad sentiment won't persist forever, and that's why shopping in the space now might be a good opportunity. And just like you, I don't understand the payment industry to the extent I want to yet, so I keep using these deep dives pretty selfishly to learn more about them, the companies and the industry each time I do those deep dives. And one thing that I did learn is that certain parts of the payments market are more attractive than others. And the remittance market might be one of those more attractive parts, and it has grown faster than the overall payment industry over the last years. But before we go deeper into the numbers, as you said, it might make sense to explain what exactly remittances are and how they work for anyone who doesn't know. So let's imagine a construction worker in Los Angeles sending $300 back home to his family in a small town in Mexico. That's the setup. But the interesting stuff is what actually happens in the background.
Well, yeah, just to, quickly interrupt you here for a second. It does seem timely to ask when we're talking about immigrant workers sending money home from abroad. Are we discussing legal immigrants or undocumented ones? And I would think that if Remitly were largely used by undocumented immigrants, for example, that might explain why the market has soured on the stock in some ways, because there is a bit of a political liability there that could affect their business.
That's a totally valid question, and one of the first things that I looked at as well. But when we talk about Remitly, they only work with legal migrants, so US citizens, green card holders, or Visa card holders. And that's a given because users have to ID themselves and they have to be banked and mostly use US debit cards for sending the money in the first place. And of course, it's not only true for remittances sent from the US, but also all the other countries that Remitly operates in.
Maybe it's a good time to also ask then about their geographical distribution. Is this a mostly US business?
The biggest market is definitely the US, sure, but growth in other parts of the world has actually outpaced growth in the US in recent years. So 5 years ago, the US was still over 77% of total revenues, and now it's a bit closer to 65%.
I do think at a high level, remittances are relatively straightforward to understand, but then the question is, what is going on the back end, and what is differentiating a company like Remitly from others in the space?
Right. So there are two key pieces that are involved here. And the first would be the payment rail on the sending side and the payout rail on the receiving side. So on the send side, the money might come from a debit card, a linked bank account, or even a cash deposit at a Western Union kiosk. That's the initiation. Once the money is collected, the remittance company, such as Remitly or Western Union, has to move it across borders and make it available in the recipient's country. And that's where the payout rail comes in. This could be a bank deposit, a cash pickup location, or increasingly also a mobile wallet like Gcash in the Philippines or UPI-linked accounts in India. Now, the actual transfer can happen in a few different ways. The first way is via correspondent bank accounts. The sender's money goes through a network of banks that hold accounts in different countries. And for anyone who knows banking, the following won't be a surprise, but the money does not actually move from one account to another. Think of it like this. If a bank A in New York owes a bank B in Mumbai $10 million and someone initiates a $300 transfer, the $300 is simply netted out of that existing balance. No physical money crosses any borders. It's just some numbers subtracted from one account and then added to another. And The money movement happens at a later stage in larger batches. The disadvantages of this approach are that first, it's slow, it's expensive, and it's also somewhat opaque. Each bank takes a cut, and there can be multiple intermediaries and various fees. That's why companies like Wise and Remitly take a different approach. They work with so-called pre-funded accounts. That means that funds are already positioned in large countries so that the recipients can receive credit instantly without waiting for money to cross any borders.
It's a really novel solution. And it reminds me of the credit card company I use, Built, that they found a way around credit card fees for making rent payments by paying people's rent upfront for them out of their own bank account and then putting a corresponding charge on that person's card to be paid whenever their next credit card bill is due. And so that does feel like a capital intensive approach, or at least not so great from a working capital perspective, where you have all these funds tied up for periods of times. It sounds like you could just have billions of dollars sitting in these core markets waiting to be used. Or how exactly should I understand that? Does that sound right?
Ask myself the same question at the beginning of my research, and it's kind of like that, but we're not talking about billions of dollars. They have carefully managed balances in local partner banks, either in their own accounts or by working with licensed local payout partners, and those are the ones holding and distributing funds on their behalf. And these accounts are pre-funded with enough money to fulfill expected short-term demand. So for example, what they expect to pay out over the next 12 to 48 hours in a certain country. They base those amounts on historical demand, real-time flow data, and also forecast models. So let's say Remitly knows that, say, $20 million in remittances are likely to be sent to the Philippines over the weekend. Then they might keep $35 million in float there just to ensure that every payout can be made instantly.
And so when that money gets paid out, just to make sure I understand, the float decreases, and then Remitly or Wise will just add that money back to those accounts from some global treasury balance that they have.
Yes, that's mostly how it goes. And that's over the traditional methods. So the ones that we described in the first approach.
So let's talk about the size of this market now. From the numbers I've seen, it is a very big market. I think in 2023, global remittance flows were reportedly around $850 billion, with about $650 billion of that going to these low and middle income countries. And that's actually more than most of the foreign aid and foreign direct investment that most of these countries see combined.
Yeah, the market is huge. That's without question. Remitly talks about a total addressable market of about $2 trillion, and that includes remittances, but also broader financial needs of immigrants and the small to medium business market. And what makes the remittance market so attractive and durable is that it isn't powered by any government or multinationals, but by millions of individuals sending their money home to their families. So these flows tend to be sticky and even counter-cyclical. I mean, people don't stop sending money to their families just because there's a recession. In fact, sometimes they would just send more if they could. So in contrast to PayPal, which would see its business decline significantly should a recession happen, Remitly tends to be one of those rare businesses that is actually recession-proof. You always need groceries and energy. That's what most remittances are spent on. The most important corridors for Remitly are from the US to Mexico, India, and the Philippines. Latin America and the Caribbean received $156 billion in remittance inflows, more than double of what they received a decade earlier. The single largest recipient globally is, in fact, Mexico. It pulled in over $60 billion in 2023, and 96% of that came from the US. That makes the US-Mexico corridor the biggest in the world. And if you add up the entire US to Latin America remittances alone, it's about $100 billion per year. That's a staggering amount of capital flowing into these economies.
It really is. And now that we have unpacked a little bit about how remittances work and which corridors matter the most, let's talk about who's competing for all of those flows. When I think about this payment flow, I still typically think about Western Union and those iconic yellow signs that they're famous for.
Yeah, they have a lot of recognition value, that's for sure. I guess you could describe the competitive relationship between Remitly and Western Union kind of like the relationship of Nubank and the legacy banks in Brazil. Historically, Western Union and another company called MoneyGram were the giants in that industry. They had massive global networks of cash pickup locations with these famous yellow logos in many, many convenience stores around the world. I would say it's not a perfect comparison though, because the legacy banks are still holding significant market share and would likely to continue to do so for a while, at least if I understood the investment case the right way. And I don't think that will be the case with Western Union. Western Union was and mostly still is a cash business. You can go into a store in the US, give them some cash, and then an hour later, a family member in a different country could pick up the same amount of cash. And that's a pretty strong value proposition. But as you can imagine, that's an offline world business model. And it's actually astonishing to think about for how long that still kept working. The remittance market took an eternity to get digitized, but that's not as surprising as it initially sounds, because if you really understand how the business works and also the consumers, it might make a bit more sense. So on average, migrant workers in the US who send money back home send about 15% of their incomes. That's a lot of money, not only in absolute terms, but also in relative terms. But on the receiving end, it's even more than just those 15% of the household income. Oftentimes, it's the biggest part of the household income. That's why trust is incredibly important in this business. In times of offline remittances, you had so-called agents who were responsible for getting the money to the households in countries on the receiving end. And you can imagine that ending this kind of relationship and instead trusting a digital provider with your money takes a lot of time. But I think that time has come now, and there are massive players like Wise, which sits at a $15 billion market cap, and some smaller players like Remitly, like Zoom, which is owned by PayPal by now, or WorldRemit.
I'm sure digitization really flipped the remittance world upside down. I'm just pulling up Western Union's numbers here, and the company is trading at a PE of 3 and a dividend yield of 9%. So either that's just a phenomenal deal, or it's the ultimate value trap and the market expects this business to go out of business soon. And when I look at the revenue and profit CAGR, it kind of seems like it might be the latter there.
The business, I think that's safe to say, is in decline. Its revenue and profits have compounded at mid-single digit rates. Unfortunately for shareholders, the CAGR is negative. At the same time, so starting from 2019, Remitly's revenue grew at a compounded annual rate of 57%. And on the earnings side, the business just went break even. Free cash flows are already positive though, at over 360 million in the last 12 months. Although one has to admit, there are certain working capital changes that we'll get to later, which boost or inflate that number by a good margin.
I'm sure that's why you find this setup so intriguing right now. A fast growing company with lots of earnings potential that is maybe not obvious yet. And yet, if you screen for a fast growing company that is already profitable, Remitly is, of course, not going to show up because the underlying earnings power is still masked from all the investments that they're making. And it's very similar to what we saw with Uber and Amazon in different ways for a long, long time before it became clear, and in Uber's case, just recently, how profitable the business actually is.
Uber is actually a pretty good comp to understand the investment case. Of course, it's operating in an entirely different market and also a much larger company even back then. But when I researched Remitly, I saw similarities to Uber here and there. Both companies began by aggressively acquiring users in a fragmented, operationally complex market, pouring money into marketing and infrastructure to establish early dominance. And for both companies, the core economics didn't look great for a couple of years before the company prioritized reach over near-term margins. And then at some point, the business just hit an inflection point. As customer acquisition costs fell, repeat usage grew, and fixed costs were absorbed over more volume, and then eventually profitability flipped. And Uber is now, as you know best, a $7 billion free cash flow machine, but just 3 years ago, free cash flows were negative $700 million. Remitly is earlier in that journey, but at least to me, the pattern looks somewhat similar. Break even first, then growing profit margins, and eventually high quality recurring cash flows from a sticky customer base. And just as Uber's moat solidified, even as competition tried to chip away, Remitly's infrastructure, corridor depth, and compliance footprint may prove just as defensible, whether the competition is Xe, which is another online or digital first remittance company, Wise, or perhaps even stablecoins.
It's so hard to find like-minded folks who speak the language of value investing. I know most of my friends and family are tired of hearing about my stock picks, so that's why we created the Intrinsic Value community. It's a vetted private network for sophisticated long-term investors who care about deep research, sharing actionable investment ideas, and making meaningful connections. After a certain point, reading yet another value investing book only helps so much. Beyond actually getting my feet wet in picking investments, nothing has helped me more than getting feedback from a peer group of passionate investors who have supported my investing journey over time. From community debates about investment opportunities to calls with industry experts who share their unique strategies and insights with our members, it's a special group that I couldn't be more grateful to have been a part of. Spots in the community are limited though, and our latest cohort of 30 members filled up lightning fast, and our upcoming cohorts will probably be even smaller. If you want to take the next step as an investor, then go ahead and join the waitlist for our Intrinsic Value community at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. What do you keep in your cupboards? If the last few years have taught us anything, it's that food shortages can happen fast. Empty shelves, inflation, supply chain failures, we've seen it all. I remember walking the nearly empty aisles of our local grocery store in 2020. It was a scary feeling that I'll never forget. As is true in investing too, it's best to be prepared, not surprised. Don't rely on grocery stores who always have what you need. A Harvest Right home freeze dryer can help you prepare for minor or serious food shortages. And with a freeze dryer, you can preserve your favorites. Freeze dry meals, snacks, fruits, and even ice cream, so your family always has real food, no matter what happens. The best part is it's affordable and easy to do, so stock up now while you can. It's a simple, affordable, and tasty way to secure your food supply for the future. With a Harvest Right freeze dryer, you're not just storing food, you're protecting your family. It's peace of mind. Learn more by visiting harvestright.com/investors. That's harvestright.com/investors. Hey guys, this is your host of the Intrinsic Value podcast, Shawn O'Malley. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. It's a really fascinating comparison you've made here. And ironically, I actually feel like I have more of an intuitive grasp of what they're doing than what PayPal does. But maybe that's just because I've read a number of pitches on Wise before. So I kind of feel like that was a good prelude to Remitly. And we talk about this a lot on the show, but scale is so often everything. Being able to spread out fixed costs over a wider revenue base is one thing, but also all the data that comes with having the most scale can further compound those competitive advantages. And one of the concerns for me with any intermediary business, whether that be Remitly or Uber, is this question of how sustainable the fees and the take rate are. And with Uber, that take rate is very high as a percentage of the overall transaction, but objectively, they as a network can support the fastest pickup times in the most areas. And they have this network effect of drivers that no one else can really match. So it might make sense to pay a premium to use Uber for the convenience. So in other words, it's a differentiated service, and that helps justify the higher take rate. And with payments, whether that's with PayPal or Remitly, I have these terminal value concerns from the businesses where it seems like the ultimate thing they're competing on is cost. I'm not sure why people would have any loyalty to one service over the other beyond what is just cheapest and most convenient. And I worry that that drives payment intermediaries to fight over smaller and smaller cuts of payments over time, where they're really ultimately competing on cost instead of competing in any kind of differentiated way. And we saw that with stock brokerages until commission fees eventually went to zero on stock trading. And I guess I always like to be a devil's advocate against myself. I mean, the counter argument it would be to say the move to zero fee trading didn't kill Schwab or Fidelity. And I know we talked about that before our call, Daniel. So I guess having scale can actually provide some optionality where if your current business model falls apart, you have the almost first crack at the new paradigm shift of what your business model can look like for Schwab in a post zero fee stock trading world, and for Remitly in some kind of world where they are forced to take a lower share of payments and changing their business correspondingly.
Absolutely. I mean, scale matters most. And in the end, that's why I liked PayPal so much. And I think that's why you could get on board with PayPal, because the scale the company just has. And they are the biggest payment provider, and that comes with lots of advantages. And it's no different in the remittance space. The first big advantage is cost efficiency, of course. At small volumes, fixed costs like customer support, payment networks, and all of that have a much larger impact. But as volume grows, these fixed costs spread out over more and more transactions. And as the leader in the migrant worker remittances, they start to see these scale advantages play out. Despite their still small size, they negotiate better deals with local banks, mobile wallets, and payout partners, and marketing expenses decrease because word of mouth becomes more impactful. From 2019 to today, SG&A as a percentage of revenue declined from 54 to just 37%, and R&D went from 25 to 20%. Just over the course of this year, the marketing spend as a percentage of revenue again dropped by almost 5%. So they are saving, and I do think you see some scale advantages, because I would argue the remittance space is just a small niche of the payment space, and the actual competitors are probably not as many as you would think at first glance.
Again, it reminds me of our portfolio company, Nubank, where word of mouth has proven to be a much more highly effective driver of customer growth, just because their product has been so much better than what the legacy banks could provide. And I guess that customer stickiness in this space is also higher than in other payment spaces. And as I said in our PayPal episode, I don't really know why I continue to use Venmo weekly, beyond the fact that I started using it in college and most people I know use it. And for me, it would be simple to change, but yet I'm still here using it. And so if you trust someone with money that could decide whether your family can go grocery shopping the next day, I mean, the stakes are way higher for what payment platform you're using. And like I said, there's no stakes for me, and I already have trouble switching. And so the threshold is going to be so much higher for somebody whose family is on the line in terms of what platform they trust to remit their money with.
I believe this is a factor that is underappreciated for the P2P business, especially in advanced economies, and even more so in this sector. Technically, and you basically mentioned it, I could use another app than PayPal, but I've used it now for 10 years and have not once thought about actually changing it. And same for you with Venmo. And with Remitly, that's even more unlikely, just for the reasons that you already mentioned. And generally, think about all the data Remitly has to get from its customers. That's sensitive data, and you don't want to give that to just any app just for trying them out. Data is actually the second advantage that scale brings in this case. Customers have to list their names, date of birth, email, phone number, government ID, sometimes also proof of residence, and all of that stuff. And as soon as they start sending money, that's when Remitly can start gathering all the payment data. This helps improve risk management, fraud prevention, float management, and of course, also customer support and satisfaction. And by now, 92% of transactions are dispersed in less than 1 hour, and more than 95% of transactions do not need any customer support along the way. And those are pretty strong stats.
When you say 92% of transactions are dispersed in less than 1 hour, you're talking about every single transfer 24 hours a day, 7 days a week across all corridors globally. That means that whenever someone sends money from one country to another, 92% of the time, the recipients has those funds within 1 hour. Is that right?
Exactly. And I would have said that sounds pretty insane, right? But since I know that you're way more knowledgeable on Bitcoin and the entire blockchain space, I don't think that's too surprising to you. But I think that's what we have to understand when we talk about this business. I know sometimes payment seems pretty abstract, and that makes it harder to understand the competitive advantages in this space. And I wouldn't go as far as calling them moats, but there are definitely advantages in place, also for companies the size of Remitly. And in this case, the complexity of the business lies in how remittances are handled. Every country is different. In the Dominican Republic, you still have cash deliveries to your doorstep, while many countries in South America are totally digital and only use mobile wallets. Remitly must have the right system in place for each of those countries. And perhaps that's the reason why we do not yet see stablecoins or Bitcoin handling the transaction. And that's yet another advantage of scale that you slowly build, and that's corridor optimization. I mentioned it before, but the more volume you put through key corridors like US to Mexico or US to India, the better you can manage the complexities of those markets. And part of that is pre-funding balances and negotiating with local partners. And all these advantages we listed here, they kind of reinforce each other. Once again, creating one of those flywheels that you and I love to see. More volume means more customers, which leads to better negotiating power with partners. That reduces cost, which, due to the scale economies shared model, can then be passed on to consumers through, for example, lower pricing. That's the customer acquisition aspect. And that leads to the data advantage, where more data improves your risk management, which leads to less fraud, which leads to more satisfied customers and lower costs for Remitly. Again, I kind of think you see what I'm talking about here.
When you talk about Remitly as the leader in the space and a beneficiary from the scale that comes with that relative to their competition, I'd be curious to hear your opinion on Wise. And I think, as you know, Daniel, here at TIP internally for international payments, we use Wise. So I just would like to know why you think that they, as a competitor, won't benefit more from scale, given that they're about 5 times the size of Remitly.
Wise is probably the company that comes up most or is mentioned most as a competitor. And it's the obvious answer if you look for a digital first competitor in the remittance space. But on a closer look, the two companies seem to be very different structurally. It's not a perfect comparison, but to perhaps keep the Uber analogy going a bit, Wise might be what, I don't know, Tesla is to Uber. Could Tesla's robotaxis theoretically displace Uber? I would say yes. Would it improve the ride-sharing market for consumers? Very unlikely. You would say definitely not. And it's not a perfect comp, but I'm giving my best to include some companies here as comps so that we can just, better understand it. And to a lesser extent, I do think the same is going on with Remitly and Wise. The first major difference is the send amount. And with that comes also a different customer base. So just recently, Shawn and I had the opportunity to invest privately in OpenAI. It's an opportunity that came on our desk thanks to one of our phenomenal members in the Intrinsic Value community. And in case you listen to this, thanks again for that opportunity. And we must say it was given to us on a pretty short notice. And my bank wouldn't wire the money directly to the US. It didn't help that this was also on a weekend. So the obvious solution for me was to get my money onto Wise and then send it to the US account that way. I'm sure Wise is handling all kinds of transactions, but most of them are from people like you and me, and they tend to be higher ticket than most remittances, especially those of migrant workers. The average ticket size on Wise is between $3,000 and $4,000. On Remitly, it's just about 10% of that. It's a totally different customer, and both companies want that different customer base. Wise wants to attract you and me, or better said, companies like TIP, so small and medium businesses that need international payment solutions to pay their employees.
And I presume they focus on that market because it's objectively the bigger opportunity.
Absolutely. The market has a size of about $12 trillion. And as mentioned earlier, the remittance market for migrant workers has a total addressable market of about $2 trillion.
And still, though, why can't Wise try to go for both. I mean, $14 trillion in TAM sounds a whole lot better than 12 trillion.
That's true, but as you and Manga have both figured out, and I guess he copied you on that end, specialization wins most of the time. The user experience, the marketing, the payment network, the customer service, all of that is totally different depending on which customer base you want to attract and then also serve. So if I want to make an investment and the payment doesn't go through fast enough, that's definitely annoying, but it's a luxury problem. If someone sends money to their family so they can afford groceries for the next week, that needs a whole nother level of attention and customer service. One very practical difference, just to show you, Shawn, how that difference matters, is that with Wise, you can only send remittances account to account. But as I said, in the Dominican Republic, for example, people want cash delivered to their homes. In the Philippines, people want their money in their mobile wallets. Every corridor is different, and for Wise to focus on that would mean a significant shift away from what currently is their biggest strategy.
Another problem here, and we've seen it with larger and really more importantly, already profitable businesses, is that once they reach that stage of maturity, of recurring profitability, they rarely want to go back to spending a lot of money on these expensive growth plans that might support long-term growth, but if it's going to set them back on short-term profitability, it's really hard to sell shareholders on that. If investors don't like to see it, then it's less likely to happen. And I could imagine going after the migrant remittance market would mean a lot of investments in marketing and customer service and building new relationships and all that stuff. And ultimately, that would be just to get into a business with a smaller TAM and smaller transaction volume.
Yeah, I think that's a big part of it. And one thing that makes me also bullish on Remitly is a very simple one, and that is that customers love it. And I know this argument seems a bit weak and naive at first, or at least sometimes when I hear it, I roll my eyes when investors say that. But when there are certain data points that back this argument up, I would say I most of the time accept it. When we talked about Nubank, you told me about their incredible customer acquisition through word of mouth. And we see the same also with Remitly. Marketing spend goes down relative to revenue while the company keeps adding millions of users. The average account growth in the last 5 years has been almost 50% a year, and the retention rates are also extremely high. After signing up and using Remitly for a year, the retention rate is about 90%. That's what management is telling us. And while I don't have any data on that, I would assume they are probably as high as 90% right from the get-go, especially after you send perhaps 2 or 3 payments. Ratings on Apple's and Android's App Store are 4.9 and 4.7 with a combined rating of 3 million. So that's a whole lot of ratings. And remittances almost work like recurring revenues. They are sent regularly, often monthly or at least quarterly. And that's another advantage that you have compared to a company like Wise, where the main business is people like you and me who do not invest in OpenAI every single month or on a quarterly basis.
So if we assume Wise is not a close competitor, then I would assume we're talking about the legacy players like Western Union and MoneyGram as really being the entities that Remitly is trying to steal market share from. But can you confirm? I mean, is that who Remitly is really competing against and winning against?
That is who they are competing against, and definitely that's not a very tough battle to win. On YouTube and Spotify, you can now see a chart that basically displays pretty well how Remitly is taking market share from Western Union and also how much more runway there is just by taking more share from that one company. In 2019, Western Union's revenue was about $5.3 billion compared to only $126 million for Remitly. And since then, Western Union's revenue has declined by a 5% CAGR to barely over $4 billion. And at the same time, Remitly has grown revenue at a CAGR of 57% to over $1.3 billion.
That is not a good looking chart for Western Union. But perhaps it's time to now talk about Remitly's moat, or at least their competitive advantages, since it sort of sounds like they're too small to really truly call it a moat. And ultimately, we have a fast growing market here, and we have these legacy players that are ripe for disruption. So you would think that that would attract a whole lot more competition than just Remitly. You would think it would bring in a lot of these digital first players trying to steal market share from Western Union.
New competition coming in might be what makes or breaks the investment case for Remitly. Building deep moats in the payment industry, and I think I don't need to tell that to you, is incredibly hard to do since the barriers to entry and the potential to differentiate oneself are generally pretty low, at least early on. And as we talked about, once you reach scale, things change a bit. In the remittance space, there are about a handful of digital first players, actually a little less than that. The main players include Xoom, which is owned by PayPal, and it's, by the way, Zoom, but with an X instead of a Z at the beginning. Then it's Xe.com and Ria. But despite being digital first, all three come from a slightly different angle. Ria and Xe.com are actually both part of the parent company Euronet, and together they move over $50 billion in 2023. So combined, they probably are slightly larger than Remitly, but they're growing significantly slower. Remitly is growing at 38%, while they are only growing at 8%. And by now, the companies might be somewhat similar in size, at least in terms of percent volume. And revenue-wise, they are still a bit ahead at $1.7 billion. That's the latest figure I could get on the company because, like I said, it's private. So I would assume the take rate is a bit higher than Remitly's. I have to guess here since, like I said, the company isn't public, so I don't know the exact data. However, a higher take rate makes sense in this case because Ria still relies heavily on its cash payout network, which spans over 500,000 physical locations. So while it's big, it's not entirely a digital first player, and it has a lot of legacy infrastructure. Because of the higher complexity and cost of such a business, it would just make sense to also charge a higher take rate, although margins generally would probably still be lower.
Just to say it again for the listener, combined, Ria and Xe.com are a bit larger than Remitly, but Ria is mostly still what you call an old school remittance company, kind of like a Western Union.
Exactly. Ria's digital app is growing, but it's still only a slice of their overall business. Remitly, by contrast, is 100% digital, which means it doesn't have to pay agent commissions or run physical storefronts. And that creates a big difference in cost to serve and also in how scalable the business actually is. Xe.com is much more digital, but their customer focus is a bit different. I've also read through plenty of customer reports, probably too many, and Reddit was also used again, of course. And it turns out that Xe.com tends to be on the cheaper end of the spectrum, but it takes significantly longer to get your money. Significantly longer means instead of an hour, as with Remitly, it can take a day and sometimes even a couple of days, at least when you trust the reports and the ratings that I've seen. It's also much more focused on expats and small businesses, and everything is bank to bank. And that's also why it doesn't matter too much that remittances take longer. They are not really targeting immigrant workers who send money home for essentials like grocery or energy.
Yeah. Okay. So it sounds like Xe is closer to Wise than the Remitlys of the world.
I would say so, yeah. I expect the average ticket size, and once again, I don't have the data, to be much larger than Remitly's as well. So Wise is probably a better comparison. From what I've heard, Xe is something an expat would use to, for example, pay rent in another country, not something a Guatemalan construction worker in California is going to use to send $100 home to his family. And then, like I said, there's Xoom. And since I didn't even mention it in the PayPal episode, you can probably imagine that it's not a vital part of PayPal's business, and it has been very neglected in recent years. There's even rumors that it will be sold at some point, and it's not a bigger part of the strategy. It wasn't back then, it isn't now, and it tends to be on the consumer side just a more expensive player than the others, and it also takes longer. So I don't think this will be a competitor at any time. PayPal acquired it in 2015, and I guess it was part of the broader strategy to get PayPal into as many markets as possible and increase its reach, which is something that we discussed in our episode, but it just didn't really work out. As I said earlier, in a space like this, you won't be successful doing remittances just on the side. This market will be dominated by companies that commit to this 100% and just want to deliver the best service to the users. That's why I emphasized in the intro that Remitly, from the get-go, focused on the niche market of remittances for migrant workers and nothing more. And as we discussed before this call, if we say that, let's say, stablecoins or any form of crypto will be used, I really do believe that the companies currently dominating the space can be the ones doing that. But to just jump on that bandwagon, you need to be the market leader. You need to have scale and you need to know what's going on in the market. And I do think that's more likely to be a company than Remitly, than, a little branch of PayPal.
So that is the elephant in the room, though, is stable coins. And I think you said you don't really see them as a threat to PayPal because there's just not that much reason to use stable coins for peer-to-peer transactions with friends. And there's no real incentive maybe for consumers to adopt them in e-commerce either, because we already have credit card programs with great rewards and fraud protection and pretty wide acceptance. And for stable coins to be attractive, you'd almost have to have retailers fund similar incentives to use them in the way that we use credit cards. And even then, probably only the biggest retailers like the Amazons and Walmarts of the world could even really seriously think about doing something with stable coins. And again, who funds those initiatives, though? I would probably think Amazon and Walmart, it's not going to make a ton of sense for them because the cost of providing some sort of rewards for using stable coins would probably cancel out any of the savings they get from not having to pay fees to Visa and MasterCard. And merchants selling on those platforms are really probably not going to be happy to pay those either. So for anyone who isn't familiar with the term, stablecoins do come from the crypto world where they use blockchain technology to process transactions. Unlike Bitcoin, the value of stablecoins are pegged to designated fiat currency. So you might have a stablecoin that uses the Ethereum network and is worth exactly $1 at all times, at least in theory. And so let me ask you, how about international money transfers? I mean, this is a space where the traditional rails are slower and more expensive. And from everything I've ever heard about stablecoins, this is sort of exactly what they're meant for. So why don't you tell us, do stablecoins really make more sense for cross-border payments like remittances?
Well, I have to give the same disclaimer as in the PayPal episode, which is I'm still no expert on this. And I gained some knowledge from, the PayPal research and now I looked at it from a slightly different angle. But it's hard to have a strong conviction on this because no one really knows how it will turn out. And we both discussed how even 10 years ago, people thought we might even pay with Bitcoin at this point, but to the least, people would use it to send money across borders. So yes, on paper, stablecoins make a lot more sense in cross-border transactions. And if I'm not mistaken, the big improvement that stablecoins can bring is not necessarily just speed or lower costs. It's more about access. Banks do not serve everyone, especially not in emerging markets. And stablecoins need no banks and technically also no intermediaries. I say technically though, because there is a big difference between what's technically possible and what actually works for people who send and receive payments every single month. When we think about remittance services, one of the biggest problems they solve is the last mile problem. And most recipients don't have crypto wallets. They didn't have them for the last 10 years, and perhaps they won't have them for the next 10 years, although we don't know that. Right now, they want cash or money deposited into a mobile wallet or a bank account that they already trust. So unless there's a way to off-ramp stablecoins easily and locally, that theoretical instant transfer kind of hits a dead end here, at least to my knowledge. And there are still some onboarding hurdles for senders as well. You need to open a wallet, verify your identity, convert fiat to crypto, and then pay gas fees. And gas fees, as you probably know way better than I, Shawn, are fees that you pay for transactions on certain types of blockchains. Compare that to Remitly, where you open the app, enter a name, and then hit send. And if anything goes wrong, and that's one of the most important things, 24/7 customer support in your own language. Remember how long it took and still takes to just move away from Western Union to digital players. I just don't buy at the moment that the same customers now switch over to stablecoins in a matter of months when it took them 10, 20 years to switch to what definitely is a better product than Western Union. And I totally see the use cases of using them as a store of value in highly inflationary currencies. But as we repeatedly said today, remittance payments are used to pay for essentials, not for savings or to accumulate wealth. So you gotta know that the money is worth today what it's worth tomorrow. And stablecoins might do that. Bitcoin definitely couldn't do it.
I think people probably get tired of hearing about crypto and they're maybe not expecting to hear about crypto in our podcast. And we're not trying to linger on crypto beyond the extent that this is kind of where the use cases make a lot of sense on paper. And so, we kind of have to talk about stablecoins because it is a pretty legitimate alternative, at least, that has arisen. And so it's not to say that stablecoins won't eventually come or that they're not legit, but at the same time, 10 years ago, there were people who thought that everyday transactions would be all taking place in Bitcoin or Ethereum by now, and that hasn't happened. And the use cases for something like Bitcoin has evolved a lot. And yet here we are still using our credit cards and paying for things in dollars and using the Visa network. And it's maybe a tangent, but there are people who would argue that Bitcoin is more a store of value and an alternative to gold than a currency you would use on an everyday basis, at least currently. And so again, that's not to say we should totally write off stablecoins because it's a completely different thing than Bitcoin. But at a minimum, I just think meaningful mass scale adoption, even if stablecoins are a superior technology, is probably going to take longer than people think.
That's exactly where I'm coming from too. I can also see how stablecoins will be used in payment and remittances especially, but I think it's just much more likely that today's payment giants will introduce them to customers. Now, is Remitly such a giant right now? Definitely not. Could it potentially become one at a certain point? Maybe. Remitly already runs a multi-rail system, so that's bank wires, card networks, pre-funded accounts. So if stablecoins can help them to move float between treasury accounts faster and cheaper, they will absolutely plug that in. And the end user won't even know or have any trouble with setting up wallets or anything like that. They will still get their money in an hour, and if they want it in cash, it will be in cash. If they want it on a mobile wallet, it will be on a mobile wallet. But maybe it's cheaper for Remitly to make that happen. And they could pass those cost savings to the consumers, which in turn improves the service even more and therefore might also increase the adoption rate of digital versus offline remittances because, there's still this big market that Western Union has. And Remitly has been investing in stablecoin space for years now, as so many of those payment companies do. So I think them implementing it instead of getting replaced by it is a more likely scenario. And the same goes for PayPal, but also, of course, for Visa, MasterCard, and all of these major players.
Well, for anybody who listened to our PayPal episode, it is going to ring familiar again because it sounds like you don't see stablecoins as being a thesis breaker here with Remitly either. But I do want to ask you what that thesis breaker could potentially be then, because this is still a relatively young and small company. So maybe that alone makes it more difficult to have high conviction and then being a major winner down the road. But still, there has to be some kind of risk lurking on the horizon that gives you pause about wondering whether they will be the winner long term.
If you have to reach scale and be kind of the biggest player in an industry and you're still young and a small company, there's always plenty of risks that you have to pay attention to. And we mentioned how scale is the main advantage in this market. And that's why it's just so important to always be on top of mind to say, okay, is this company actually still on track to get there first? And the first possible risk is that the returns on future customer acquisition just simply goes down, which would hurt the thesis that Remitly is at an inflection point. Remitly has been growing accounts quickly. And we mentioned for Nubank that fast growth is not always a good sign, especially in the finance sector. But in this case, it seems to be healthy growth. New cohorts are still more profitable than the older ones, and fraud rates are still very low. But growth is expensive. Remitly used to spend over 40% of revenue just on marketing. And while that has come down from past levels, it's still high at about 25% of revenue. So for comparison, most of Remitly's competitors, the ones that we named already in this episode, they spend about 4 to 5% of the revenue on marketing. So that's significantly less. Now, the payback time for an acquired customer is well below 12 months, according to the management. And the lifetime value of a customer currently is about 6 times higher than the acquisition cost. And I think you could even argue, if you look at the numbers, that's probably 8 to 9 times higher. So the return on their marketing investments are huge, but it is still a temporary drag on profitability and therefore also on the stock. And if management continues to spend on marketing, it will probably be so for a while. And I think they will do that. But as they do it, I think they're smart about it. Marketing where they really catch migrant workers. They have among the highest ROIs on their marketing dollars. So I'm more than fine with it if they do decide, to keep marketing spend higher for longer. It's kind of similar to what Booking.com did and the playbook they use. It's a company we haven't yet covered, but Clay did so on the We Study Billionaires show. And the travel booking industry doesn't have strong natural moats either, but Booking spend on marketing like nobody else in the industry did. And their marketing spend is still in the mid 30s if you measure it as a percentage of revenue basis. So I think that's the playbook that Remitly is using. And I think it's working out until now.
Booking is like a good company for us to probably get more familiar with, given that we have Airbnb in our portfolio. And it's just a fascinating case study in how you can build competitive advantages in a business that sort of looks like a commodity on the surface. And at the end of the day, Booking doesn't own hotels. It just lists the rooms. But what it does own is demand. And it got there by pouring billions of dollars into performance marketing. And a lot of that was on Google. And for years, this was called the Google tax, where Booking would spend 30 to 40% of its revenue just to get in front of high intent travelers searching for hotels. But the key to building their moat has been, and still is, what happens after that first click. But Booking turns those paid clicks into app downloads, and then loyalty program members and repeat customers who later start their search directly on Booking the next time they go around. And for Remitly, I'm not really sure exactly if they have the same level of customer lock-in and how that would work, but I imagine it's mostly has to do with the trust in the brand that Remitly can kind of give them by consistently ensuring that payments make it to their destination. So I assume that's not something you would classify as a threat to the thesis, but what are the things that you see as existential threats here?
Just on that last point, it is in fact more difficult for Remitly to turn customers into long-term customers. But right now that works without any problem, as retention rates of over 90% show. And as you said, that's mostly because they have what I would consider, and I just heard that from other people, I don't use it myself, they have the best service and customers trust them, and that's worth a whole lot in this business. It's not a subscription service or rewards program, but the payments are highly recurring. Many of them are even scheduled. So once everything is in place, you typically don't switch it up. But yeah, getting to the next big risk factor, and one that actually has the potential to break the thesis, and that's regulation. Just recently, we saw the big, beautiful bill causing the stock to tank. In fact, the stock got hit repeatedly due to Trump's focus on illegal immigration, but that shouldn't matter for Remitly too much because, as we said before, their customers are legal, documented migrant workers with a US bank account and US debit cards, so it shouldn't matter that much. But in the bill, there was a section that proposed a 5% excise tax on remittances sent by US residents who are not US citizens. So also legal immigrants, green card holders, visa holders. And first of all, it would have been highly questionable if this is in line with the laws against discrimination of, permanent residents. But fortunately, we don't need to worry about that much more because it's not part of the bill that actually passed.
I guess this will probably not be the last headline we've seen about migration that could hurt Remitly in the short term. But the payment industry really hasn't been the only one that's experienced some unexpected headwinds, I wouldn't say.
Definitely not. I mean, the last few months, we had to discuss politics way more often than I think we both would like. But, getting to another potential risk, which is not regulation, which is not politics or Bitcoin and crypto, but perhaps the biggest risk that Remitly is facing is the one of competition and the potential margin pressure it can cause in the long run. Remitly's take rate today is around 2.3%, but that number could get squeezed over time if other digital competitors start to gain more traction. And while Remitly built strong brand trust, remittances could become commoditized in the future if the consumer's preferences shift and price becomes more important. And you basically mentioned that. I think what I currently see in the market is that a lot are willing to pay a little bit of a higher price if they know the brand that they're working with and that the money is actually getting there. But that could change. So the fear is of what you said, a so-called race to the bottom that we also discussed with PayPal, where take rates fall endlessly due to price competition. And while it's true that payment processing has natural pressure or natural price pressure over time, the data doesn't show a straight line collapse in take rates. For Remitly, as I said, take rates have actually been remarkably stable at around 2.3% in recent years, despite growing volumes and also new market expansion. And of course, the company is young, so take it with a grain of salt, but I still think it's worth mentioning because it is kind of a trend that you see. In part, it's also because there's just still so much more room to grow for all the players so fiercely competing already is just not what happens at the moment. But the main reason is, in my opinion, that remittances, and I said this before and I will say it again, are not just a commodity transaction. They come with all the complexities that we already discussed: regulation, fraud risk, foreign exchange spreads, and the need for, local payout infrastructure. And because of that, the remittance space is, I would say, more insulated from pure price wars than domestic card payments. For PayPal, which operates more in e-commerce and merchant payments, take rates have gradually declined over time, but the drop has also been at least somewhat slow and manageable, so supported by value-added services and network effects, which is also something we talked about. They could handle it pretty well in terms of profitability. And the more likely long-term scenario to me is an oligopolistic market structure with a handful of dominant players where scale, trust, and infrastructure matter more than price alone. And in such a world, take rates might compress modestly, but it's not necessarily this race to the bottom that so many people are fearing. The winners will be those who can reinvest their scale advantages into cost reduction, fraud prevention, and user experience. And at least I think that not only the ones who undercut on pricing.
When I think about it, I think I can imagine some pressure from Western Union here. I mean, Western Union clearly isn't going to roll over and just cede market share without a fight, even if they've done a pretty poor job of defending their market share thus far. And, what if they did something like initiating a price war where they do try to drive out companies like Remitly by simply just choking them out at their own expense for a period of time. But once the dust clears, then they would be the only ones left standing because they have the cash to absorb losses for, I think, longer than Remitly probably can.
That's a very good point. I think for everyone who ever had a class on game theory and then they see the chart of Western Union declining, they would think, wait a minute, why should they just not get into such a price war and kind of destroy the competition that way? And I think it's not so likely just because Western Union and their shareholders definitely have not an interest in Western Union doing that. If you hold shares today, you do so betting on margins staying stable for as long as possible to then earn enough money to finance the dividend. And if they start dumping prices to regain customers, the dividend would have to be cut and margins would go down the drain. And I'm not sure they could do that with their shareholder base. And also, if you think about it, we just talked about competition. There's so many little competitors coming up. So Western Union might be able to do it once and then Remitly is gone. But what about the 20 other companies that come up eventually and just take their space again?
Even when we're not talking about politics, somehow it comes back to some kind of politics, even if we're just talking about internal shareholder politics. You can't cut that dividend, right? So it's some things never change. But jokes aside, in preparation for this episode, I did come across a payments industry report from a group called BCG, and they dug into the changes in the payment industry in recent years. And the biggest narrative has been that the fast growth phase is over and payment providers are now focusing more on profitable growth. And I guess that description fits PayPal more than Remitly, but it would support the thesis of an oligopoly where the market leaders now go from growth to profitability. In that process, they start to stabilize their take rates.
Yeah, that's a good point. I mean, it's kind of what I imagined how the payment industry could go on or could go forward. And it might be the reason why the payment industry also, which historically performed in line with the tech industry, if you look at stock charts, hasn't performed too well since 2021. I think investors still focus more on growth than profitability. That's what they do in the tech space, and perhaps they want the same in the payment space. Then again, Remitly isn't trading at high multiples either, quite the opposite for a company growing that fast. So perhaps they just sour on the whole idea of payments, and maybe because they see stablecoins as more of a threat than I do.
Well, talking about valuation and multiples, I think it's that time where you walk us through the details of Remitly's financials and what it means for the valuation ultimately. And I don't envy you because I've valued companies at the earlier stages of their life cycle, and it's always exciting, but it's just so tough because there's so much optionality on the upside, but there's also so much more downside.
It's definitely tough. When valuing a company like Remitly, it's important to distinguish between what the business looks like today and then what it might become once it reaches scale, if it ever does. So because of that, right now, Remitly is still investing heavily in customer acquisition and corridor expansions, all the stuff that we mentioned, but the unit economics are improving fast, and the model is already starting to show signs of operating leverage. And in my model, you can see the process that I described when I compared Remitly to Uber. It's a company that's right at the inflection point of transitioning from break even to meaningfully profitable. In 2024, Remitly processed around $55 billion in send volume, and that's the total amount of money sent from customers or moved from customers through the platform. And over the next 5 years, I could see that volume increase to more than $140 billion, which implies a compounded annual growth rate of about 21%. And that's a meaningful slowdown compared to the over 40% growth per year that Remitly posted in the last few years. But it's also a more sustainable trajectory for a business that is entering its next phase. And account growth is the other part of the revenue equation. And I see that growing at a similar rate, but slightly below, since new cohorts tend to spend more than the older ones. And that causes send volume to increase slightly faster than account growth. And revenue is just a mix of the two. And so that's why I would say, okay, it will compound at about 20% as well. And again, that's about half the historical average, but we saw growth rates decline year by year, so I do think that's more realistic. And this implies that the take rate would decrease from 2.3% in 2025 to slightly below 2.2% in 2029. And I know that's a minor decrease, and perhaps we see more of a decline, but it's more or less in line with the historical take rate decline. And I actually didn't want to model out the take rate myself just to see how business changes that I expect would actually impact the take rate organically.
Well, I know it's always hard for people who are just listening to the podcast to follow when we're using a lot of numbers, which is why I say on Spotify and YouTube, I feel like we always say this, we have the charts and the models shown on screen so you can actually see the numbers. And to that point, you know the company better than I do, but it doesn't seem like the top line growth rates are incredibly unreasonable here. I mean, from everything I've learned from you, it seems like the runway is huge. And just looking at the historical growth rates, I mean, this is not a ridiculous extrapolation of what they've recently done. And I know from my Nubank episode, there is this, as the kind of value investors that we like to think we are, there's this kind of unease in your stomach where you're like, did I really just put a 20% growth rate into a model for 5 years? Like, really? Am I okay with that? And, with Nubank, it's actually maybe a bigger assumption because they're working from a larger baseline and from a lower baseline for Remitly, just as a numbers game, those growth rates are more palatable.
I totally get what you mean. Whenever you have to assume 20% growth annually, I think the investment case isn't that great when you just assume it. And, that's kind of the base case because historical data suggests that's a realistic rate. Then you kind of do it. But as you said, it makes you pause for a minute. But when you look at the growth rates in the recent quarters and the last years, I think it's something I can be okay with. And perhaps getting to the margin side of the business, which is even more important than top line growth, 2025 should be the first full year in which Remitly is GAAP profitable. Free cash flow wise, it's already been there. It has $188 million in 2024 and over $360 million in the trailing 12 months. And the huge difference between net income and free cash flow margins comes from stock-based compensation and, most importantly, changes in working capital. And that's actually something that you brought up before the episode, just looking at free cash flow margins and net income margins, why they are so different from each other. And a lot of that working capital comes from capital that is tied up to pre-fund the balances and those accounts that we talked about earlier. Depending on when the quarter ends, this can heavily distort cash flow. So when customer liabilities rise faster than pre-funding, so Remitly receives cash while the funds are not yet withdrawn, that's a source of cash flow and inflates the cash flow numbers. And if Remitly pre-funds balances in advance and payouts hit before they receive any money, Remitly's cash flow drops significantly. And in my valuation, I actually adjusted for that by trying to reverse engineer how much of the cash flows were due to favorable timing of cash inflows in 2024, since the difference was significant in that year. The overall difference was almost $81 million. And I won't go through it here because it would be way too many numbers, but perhaps I could do it in the newsletter.
Well, I'll say that it makes sense, but also I asked you this question offline about the differences between their free cash flow and their net income. And I think I had to read your message like 5 times before something clicked. And I was like, okay, I think I understand what Daniel's talking about here. So for any listeners, if you heard that and you might have to play it back a couple times and you might still not understand exactly. But the point is, just due to accounting differences, there are some real reasons that are valid for why there are these huge differences in the net income margins and the free cash flow margins. And it really has to do with the timing of the receivables and payables that are coming into the business, because there are these large flows of cash for a money transmitter as opposed to, a normal company that their primary business isn't just the flows of money. So that kind of complicates the accounting. But regarding the stock-based comp, you did also tell me before our call that they are trying to keep this down going forward. And that Remitly CEO, Matt Oppenheimer, has passed on his last 3 stock grants in the hopes that that will help with dilution.
Yes, and to me, that's a great sign showing that, he is focusing on shareholder interests instead of just his own interests, although I got to say they're pretty aligned because he owns about $100 million worth of shares, and I would assume that's the majority of his private net worth as well, so he's pretty aligned with the company and the shareholders in general. It's also not unusual for a company in its early stages to have a lot of stock-based compensation. Reddit, for example, which is a company that we have in our intrinsic value portfolio and you're a fan of, and that only IPO'd in 2024. So obviously they also still have a lot of stock-based compensation. The size of, I think it was 24% of gross profit. Uber is about 11%, and Remitly currently stands at 19%. And once again, that's a lot of numbers, but hopefully it makes all more sense if you just, see the charts on Spotify and YouTube, and perhaps otherwise you just dig into the newsletter when it's out. And in my model, I assume stock-based compensation to grow at a CAGR of about 6% in the next 5 years. To see what that could mean for dilution going forward, I projected, at which prices this stock-based compensation could be exercised, and depending on that, you will see how much actual dilution is and the share count. And doing all of that, in my model, in the base case, you will see a diluted share count of growing about 4% CAGR. And despite that dilution, I still have free cash flow per share growing at a CAGR of 28%. That might seem aggressive, but we will see all these scale advantages and the inflection point only coming into fruition in the quarters and years ahead. And this growth rate only implies a free cash flow of $770 million in 2029, where we already saw, given all the positive headwind of these accounting changes, a free cash flow of $360 million in the last 12 months.
Well, so something you want to always think about with a young company, this, Daniel, is the steady state business and what it can look like when the company is at maturity and it's not just kind of growing at all costs. And so my question for you is, how profitable, or is there a way to figure out how profitable Remitly could already be if they were only focused on just retaining existing customers, as opposed to the additional spending on acquiring new ones because they're in the growth phase. I know you said that marketing is a huge expense for them. So I do wonder, as we're trying to quote unquote normalize their earnings, if it would make sense to adjust for that.
I'm glad you asked because I spent way too much time coming up with what I thought of as being a steady state model. So only enough marketing expenses to sustain the current user base, no additional growth. And I'm afraid this doesn't make it less complex, but I will try to keep it short. So I'll walk through the math in more detail in our free newsletter, as I said, that we send out each Sunday, and basically discussing the company that we also pitched on this show before. But basically what I did is to reverse engineer the average customer acquisition cost by using some of the management comments throughout the years to base my assumptions off. And doing that, I get to about $90. Now, new data from Q1 would suggest that the customer acquisition cost might be closer to $85 already, but let's stick with $90 for now, since those are the full year numbers of 2024. If Remitly ever stopped chasing growth and just spent enough to replace churn, which is about 10% per year, you would only need to acquire those 10% per year. And on an 8 million active base, that's about 800,000 people. So replacing that with costs of about $90 in customer acquisition, that's about $70 million in maintenance marketing versus nearly $300 million that Remitly currently spends today. And after tax, we'll be talking about additional free cash flow of about $170 million. All of this was a long way of saying the financial power is already there, and it's just about when Remitly will show it by spending less on customer acquisition, which, by the way, I still think is the best use of their cash right now.
It's a great way to think about a business that is in growth mode. It might seem less profitable on paper than it is in reality, which is kind of a weird concept, but it does remind me a lot of those conversations we had about early Amazon when you pitched that company a while back. And Amazon is sort of the famous case study on a company that has more earnings power than it looks on paper because they were investing so much in growth that actually suppressed their profitability. And it is interesting to me, though, that you always hear people talk about the difference between maintenance and growth CapEx, where maintenance CapEx refers to the minimum amount that needs to be reinvested just to maintain the business at its current size. Whereas in marketing, you just don't hear about that concept as much. And so I think it was really an insightful calculation for you to put together, because I applaud you for breaking out maintenance marketing and growth marketing. I thought that was pretty cool. So just getting back to your base case model after hyping you up a little bit, Daniel, what fair price do you see for Remitly?
All right, so first of all, thanks for the compliments. I think most of the time marketing is not as big of a thing for companies as it is in Remitly's case, but here it definitely makes sense thinking about this. So getting to the base case, I'm assuming a 14 times multiple of price to free cash flow, which is a bit higher than the current multiple of only 10, but in my opinion, more than fair for a company that I expect to grow revenues at 20% and free cash flow at 30% per year. So this would give me a fair value of $26. However, since the range of outcomes is just much more uncertain in this case and in any of our other cases, I do slap a 20% margin of safety on it this time, which brings us to a current price target of about $20, $21 in the base case assumption. And this would still imply an IRR of 16% from today's stock price.
I feel like I know how wide the range of outcomes can be with these kind of companies, and we've kind of alluded to that earlier. So I would presume that in your bear case model, the price target might be dramatically lower in a worst case scenario.
It is. And in the bear case, I still expect double-digit revenue growth, but significantly less free cash flow growth than in the base case, only 15%, which, still is materially growing. Honestly, I don't think this is the most likely outcome, since the steady state math shows that Remitly should already reach the free cash flow levels this growth rate would imply for 2029, but who knows? Stock-based compensation could dilute shares way more than I modeled here, and perhaps retention rates decrease with more competition, leading to higher customer acquisition costs, less growth in the top line than I expect. And considering all of that, I get a price target of about $7 in my bear case. In my bull case, you see the variety of possible outcomes play out to the other side, with a fair value in the high 30s. driven by slightly faster growth and better conversion to free cash flow, but mostly due to a significantly higher multiple. I assume 21 times price to free cash flow in this case. And it's not that hard to argue that a company growing at these rates would deserve those multiples. Some, peers are already trading at those. But looking at Remitly right now, it does seem to be a bit of a stretch, and perhaps a bull case would be mostly about higher growth rates. But as you know, modeling these companies, at some point you just don't want to assume more growth than you're already expecting. All in all, even more so than in all other episodes, please take these models with a grain of salt. Forecasting 5 years into the future for a company that is so early in its journey is pretty much impossible. I would focus much more on the steady state math that we did. And from there, you just have to be convinced that Remitly's product is actually better than the competition, but also in the idea that this space will not be commoditized due to the complex nature of the remittance business. So while, to say it in, Wall Street language, the model would suggest a buy rating, I like to remember the investing wisdom. Valuation isn't one on spreadsheets, it's one on conviction about the range of possible outcomes. And this could still be a hit or miss, despite many things currently hinting to the former. It's a bet that I might take my personal account, but I don't think it fits the risk profile of our intrinsic value portfolio. And I would just assume you agree with the concerns, but tell me if that's not the case. Tell me if you are completely sold on Remitly.
I don't want to, I don't know. I don't want to say too much specifically on Remitly because I'm over here saying that I'm not a payments expert. So who would I be to argue with you on, banging the table for why we should add Remitly? But
I'm not either.
Yeah,
though.
right. Well, true. Exactly. Yeah. So I would just want to say that for anybody who's listening to this and they're saying, well, it's kind of puzzling that your models say one thing and then you're doing something else. And it probably feels subjective to longtime listeners of the show because sometimes it might seem like we're choosing to closely adhere to the models we build. And then other times we're kind of whimsically dismissing the valuations. And as you're suggesting here with Remitly for non-quantitative reasons, I would say. And I've talked about this before, but it really is worth emphasizing that we are breaking down a different company every single week. And we're doing dozens of hours of research on these businesses before we distill it down to a model and then talk about it on the show. And the point is that we're churning through a lot of businesses. And it's just not possible to be equally confident in every model we build. If somebody tells you they're equally confident in every model they build and they're doing 30, 40, 50 models a year, I wouldn't trust them because it's just not possible. And so I know from experience that sometimes I build a model and I feel like I have a very strong grasp of what's going on with the business and the industry and the competition. And therefore I have so much more conviction and comfort in the assumptions in the model. And then with other companies, it's just not possible to feel the same way. And circle of competence is a real thing. And it's so much easier to value businesses that you've worked with or you've used before, or you have some expertise into the industry for whatever reason. And with remittances, this is a world that we both have very little familiar in with outside of the research we've done for this episode. And so when you layer that over a pretty fundamentally uncertain business that the market itself is unsure about, that just makes everything so much harder. And that really is why the concept of the too hard pile exists. It doesn't have to mean that the stock is banished and is always too hard, but it means at this moment in time, relative to our other opportunity costs, we would probably be better off spending the next hour of research looking at something new rather than going deeper on Remitly. That's how I think of the too hard pile. And that's what I say. I think we set aside Remitly for now. It's in the too hard pile. But, a lot of our favorite writers on Substack and some of our friends and stuff follow Remitly closely. So I don't think this is a company we're going to just totally forget about. And maybe at some point down the road, and this is kind of a cop-out, but it's true, maybe we'll revisit it.
I would also add, everything that you said is totally true. And I think the too hard pile should be exactly that. I would also add, though, that one thing that you have in a model is the price target, which is blended from all three scenarios. And the other thing is looking at, wait a minute, what downside does the bear case even have? So if I have a model which suggests a certain upside, but the downside might only be 20 or 25%, I can have a lot more conviction in that. But if my model shows a blended price target of, let's say, $20, and that is a pretty good upside, but the bear case is 60% below the current market value, then I just also have to think about the risks coming from this. So we always talk about a range of outcomes. And when the downside isn't capped, I would also want, for one, more upside, but there is a limit where I would say, okay, if the downside is 60, 70% and it could actually happen, then I simply will not invest in this company, because one thing that value investors want is to not lose money. And I might miss out on, some upside here and there. But if I see a bear case to make, and we talked about it for hours in this episode, but also before, there is a bear case to make here. And if that means the company might go to zero, which is also totally possible at some point, I just don't want to invest in it, despite the blended price target might tell us, well, this is a buy target if you just look at your 12% hurdle rate. I think that's very important as well. And as you phrased it, those stocks would exactly go on the too hard pile.
As Munger would say, Daniel, nothing to add.
Perfect. All right, then with that, how about you give us your hints, as always, for the next episode?
Yeah, so next week we're going in a bit of a different direction, and I can assure the audience they'll not have to listen to another payments business again, because I kind of don't want to listen to any more about payments. I appreciate the pitches, Daniel, but it makes me tired. I don't know. It's just so much to wrap your head around. This actually, my pitch for next week is a company that first came across my radar a year ago, and I liked it then, but not quite enough to buy it. But it was kind of at the top of my watch list. It's only gotten cheaper. The stock has fallen another 20% or so, while at the same time, the fundamentals have continued to compound. So it's a company that, well, I guess it'll make more sense when you see the episode, but we'll end up comparing it with Nike a lot. And they're actually quite different, though, in the fact that Nike sells primarily wholesale, and the company I'm pitching mostly sells DTC through its own store. So there's some difference in the brand positioning. And I haven't given away too much, as maybe a last hint. It's a company that's branding fundamentally leans very heavily on what I would say targeting the upper middle class. And so you're likely to see this brand worn at Starbucks, but also at the gym.
I think those are pretty good hints. You could get it if you know the brand, and perhaps you also are aware of the investment case. And with that, let me close it for today by quoting the one and only Warren Buffett, who gives us some wisdom on not neglecting the risks in an investment and appreciating the fact that there is a too hard pile and that there are more opportunities than just this one. Quote, "The stock market is a no-call strike game. You don't have to swing at everything. You can wait for your pitch." And since I know next week's company already, I think there's a good opportunity we might strike then. So with that, I hope to see you there. Have a great day. I think PayPal's time as a value trap is over. Alex Chris's strategy shift shows first signs of success. Margins improved significantly. PayPal is buying back shares at the fastest rate ever. And we're at the early innings of an ads empire and agentic commerce.
You might be right. And when the B2B restructuring is done and top line growth picks up again, investors might start viewing this as what it is, a cash flowing machine in a fast growing oligopoly.
And while investors wait, the aggressive share buybacks increase their stake in the business. And I think it might be PayPal's time now.